What's up, everybody? Welcome to another episode here where I'm going to be talking about some personal finance topics. And on this one, I'm in my car here, and I wanted to go over a topic that actually a lot of you guys have been DMing me about that's called velocity banking. Now, if you just search up the term velocity banking, you'll see that there's a lot of concepts around paying off a mortgage in full in like 5 to 7 years. Now, that on its face sounds amazing, where wow, you could pay off a $250,000 mortgage in 5 years. How is that possible? And the reality is that it is possible, completely possible, but you're taking on a substantial risk. Now, there's all these cliche sayings like, with great risk comes great reward. Of course, that's just how it works. But in terms of the level of risk this velocity concept is taking into account, there is a substantial amount of risk that a lot of people aren't really thinking about. So also there's a little noise in the background here from the AC, and just throwing that out there. So in case you hear a buzzing noise, it's the AC. With the concept of velocity banking, what it is let's say you make $5,000 a month, and what it is it's saying you can pull out a line of credit, because the difference between a line and a loan are, you have your fixed monthly payments with a loan for a duration, and then with a line, it's liquid, it's constantly moving up and down. You can put as much as you want towards that amount and pay it down as you see fit. So the concept is, from a high level, that people are taking out large lines of credit, let's say 20 grand, throwing that at the principal and paying that down over 6 months, and doing this chunking concept where you're taking off chunks of the principal using this line of credit. Now, the interest rate is substantially higher, usually like 20 or 21% on a line of credit. So paying it down quickly is what the suggestion is. Now, you have to understand that a line of credit is with a high interest rate is a substantial risk. That's assuming nothing bad happens over the course of 6 to 7 months as you're making these payments. And at a granular level, what they're saying is every month, instead of paying your normal bills through your checking account with that $5,000 income, that all goes towards the line of credit, and you're using the line of credit to pay for everything. And that kind of eliminates the amount of expenses that you would be paying otherwise, so you're increasing your cash flow. And it is like manipulating numbers a little bit, but at the same time, it is good to constantly be focusing on cash flow. I've said that a million times before, and I also made a course on cash flow, link in description. But the idea here is that people are going to be taking out substantially big credit lines, which is okay. It's important to have large amount of credit available using little amount. Low credit usage is fantastic for lenders. They see that you're responsible. You're not using all of the entire credit line. So this strategy, I think, is it's possible, but it's dangerous. And I just want to be the person to kind of raise that flag that says you really, really, really need to plan out 6, 7 months if you're going to do something like this, and make sure you're healthy, make sure there aren't going to be any immediate expenses, because some of the things that happened in 2008, for example, was they called due the balances of some of these credit lines, and people didn't have that cash because they may have been doing something like this where they were over leveraged. And this is an example of that, where if you all of a sudden have a $20,000 chunked sum in your principal amount on your mortgage, and you're making payments towards it over 6 months in the current landscape, for example, anything could happen. And you could lose your primary source of income, and then how are you going to make those principal payments at a 21% interest rate? You are crippled by the amount of interest that would be added on to that fast. So it's a very, very high risk maneuver here. A lot of people are going to sling a little bit of hate towards me on that, saying like, great risk, great reward. You can do this, very motivational. But the numbers, if you look at them in just making an additional principal payment over time, as considered in this way a safer route, it evens out quite a lot if you actually run the numbers here. And I actually watched a video, read a couple articles on this, and if the number in that you're making each month towards a principal payment was anywhere between like $100 to $500, let's say, and you're taking out these huge chunk credit lines versus taking out these huge chunk credit lines and paying towards the principal, it's virtually the same thing. And it's just safer and over time. And if you lose your main source of income and you have a loan, there are people that you can call and talk to them about, forbearance and things like that. But with an over-levered amount on a credit line that you've thrown into the principal and mortgage that you're chipping away at and you lose your income, they're gonna definitely come after you. There's not really much flexibility there because you're basically using debt to pay debt. And this is I can see how it's attractive to people. I can see how it could work and probably does work for a lot of people out there. And, I'd love to recommend people try it on a small scale, not like $20,000 chunks, maybe buying a $1,000 item from IKEA or something like that and paying that down over the course of 2 months, something like that, 3 months, splitting the payments up. I'm all about using these different instruments that are available, but I'm not really about paying down debt with more debt. I think borrowing to pay the other borrowers, that saying, what, robbing Peter to pay Paul, isn't that the saying there? So I recommend checking it out. Of course, everyone always do your own research, always research for yourself, figure out what is important to you and your financial situation. But I do recommend that if you're going to do something as drastic as pulling out a credit line and paying it towards principal on a mortgage to pay down faster, I would definitely say that you should just make principal payments over time and definitely learn what the difference between a line and a loan are. I briefly touched on it a minute ago, but definitely do some research on a line versus a loan, because a line is extremely powerful because it is, like I said, liquid, not a fixed payment. You can pay as much as you want towards the balance to pay it down as fast or as slow as you need. The obvious answer there is that interest is going to be accruing fast with a lot of interest compared to a lower interest rate mortgage. So it's up to you, as always, with personal finance type tips. But this one is a really interesting one that I've seen a lot more YouTubers talking about, a lot more people getting involved on the velocity banking concept. Some bigger name people are starting to get involved in it. And I once again, want to be the person that raises the red flag that says, just be careful. Don't over-lever yourself. Save some cash as a reserve in the event that something happens, as a nice cushion. And once again, focusing on cash flow, because like my friend Mark Moss says, who's also a big YouTuber here on YouTube, he talks about how the real freedom and the true feeling of financial freedom is knowing how to make money. And that comes in all different types of formats. You can make money in any different way that you see fit, whatever your skill set is in. You can even just facilitate other people's skill sets and make money that way. So there's a lot of unique ways to do it. And with the whole debt concept, there's a guy named Dave Ramsey, who a lot of you guys have sent me content about him. And I find it really interesting that he is teaching a lot of people to pay off debt first and then go on from there, which is great. It's a great message, and his baby steps, I believe, are a way to walk you through getting rid of debt and saving money, saving an emergency fund, which is a big thing that everybody needs to be focused on. But at the same regard, if you're ignoring debt, you're ignoring a fundamental tool that exists. And just like fire, if you know how to use fire, you can cook, you can light your house, you can light all sorts of things, you can use it as a tool. But if you use too much of it and you don't know how to manage it, you're going to get burned to death. So it is with everything. You need to do it in moderation. You need to have control and educate yourself on how to use and maintain something like debt. It is a very much a key component to the economy. because it is just our foundation. What you're watching right now, YouTube wouldn't exist without debt. Anything that you are wearing, your clothes, many things would not exist without debt, if not most things. So it is a fundamental component to how we live in the modern age. And I do think if you do not use any sort of debt, it is a disservice to yourself. And the uber super wealthy people are, have huge amounts of leverage. So that is kind of what I wanted to cover in this episode, talking about velocity banking, talking about how I think that there are benefits to it, but there are a lot of negatives to it, primarily being a massive amount of risk that you're taking on to pay off this chunk that you could just take your time and progress through. Obviously, the bank's making money, which is a lot of the argument around velocity banking, that you can take off chunks so that they don't make as much in interest. But they're making a lot in interest because they've spread it out over time for you so that you didn't pay it all up front. And there is a devil's advocate there. So that's kind of all I wanted to cover here. Definitely leave your comments below. Shoot me a DM on Instagram or Twitter. Let me know what your thoughts are on this whole velocity banking movement of taking out a credit line and paying chunks towards your principal on your mortgage and paying off that credit line as fast as you can and increasing your cash flow and things like that. I think I have mixed emotions about it, but my knee-jerk reaction is just take it slow, take it steady, use leverage where you know how to use it, use leverage where you feel safe, and don't go overboard with leverage. Definitely learn all the aspects that are involved in taking out a credit line, things like that. Start small, use it for something extremely small like an item, $1,000 item from IKEA or something like that, or use it for something like a car and try and pay that off as fast as you can. Things like that instead of a massive mortgage, I think are a better thing to start with, starting small and learning as you go. And that is it for this stream here. Thanks so much for tuning in. If you guys like it, slap a like. It really has been helping the channel grow. A lot more people have been subscribing, commenting, and messaging me. So definitely shoot me a message, like this video, be subscribed, and I will see you guys on the next episode here.